Here to weigh in is PIMCO CEO, Manny Roman. PIMCO has roughly $1.8 trillion of assets under management. It's so good to have you here at Post 9, Manny. Nice to see you.
Thank you for having me.
What a week. So what explains the rise in yields we've seen this week?
Well, I think that, as you said, people says rates are going to be high and they're going to be high for longer. And I think that's now what the market is pricing. I think the market also priced one more raise in rate. And I think people look at the yield curve and say it was very, very inverted, and now it's less inverted. And I think you have sort of a normal behavior of the bond market with a lot of attractive opportunity.
So you guys at PIMCO see another rate hike?
We see one more.
As
the most likely scenario in September. But, once again, you have to be very modest about your prediction. And I always say the Fed will be very data dependent. And depending on what we see in the labor market, Chairman Powell will act accordingly.
When do you see the first cut?
Not for a while. And I think you have to put yourself into the mind of the Fed. What's the incentive to cut too quick? Not a lot. And so we think they'll be careful and that they'll keep rates high for a while. And
like second half of next year or even farther out? Or
even further up. And once again, it will be very data dependent. Of course, if there's a recession, they'll be quicker to act. But I think they have a lot of dry powder, which is a good thing for the Fed.
We've had Clarida on in the last few weeks. He did suggest that if not a cut in March, maybe a signal that cuts could be imminent is not unthinkable.
Totally. And as you know, Rich is our chief economist, so who am I to disagree with him?
So is the House view within PIMCO then? Are there a bunch of, is it wide?
No, I think we very much agree on this. I think what surprised us is that the economy has been quite strong and the labor market remains quite tight. And I think that's something we're going to watch quite carefully over the months to come.
Do you guys think we've seen the highs in yields for the cycle?
My crystal ball is a little broken, but we're very close to a high. And I think the way we think about it is rates are very attractive. What's the exact high in terms of what the 10-year will be? Honestly, we don't know. But over the next 18 months, they should offer excellent value for investors. And I think that's the exciting part when you're sitting where we are in the bond market.
Well, that's what I was going to ask. So you said 18 months. There's this narrative going around that we should all just get used to higher rates and that the abnormality was what we saw in the last, 15 years, post-financial crisis of super low rates. Do you guys see us getting back down to that kind of regime, or are we stuck up here near 5% on the 2-year for a while?
No, our view, and Rich was explaining this last week quite well, is we think that inflation will go back to the high 2s, and accordingly, you should see rates come down across the curve, and that's one of the reasons to be excited about bonds. And of course, if there's a recession, it will go faster.